Here's an economic question. If inflation is simply prices rising too fast, why doesn't inflation fall immediately after the price of energy drops? For example, between June 2022 and June 2023, US gas prices fell by more than 20%, yet overall consumer inflation declined much more slowly. Why didn't lower fuel costs quickly translate into lower prices everywhere else? Welcome to Econopoly, where we break down how the economy actually works using real data and simple explanations. The mechanism behind persistent inflation is inflation inertia. Inflation inertia refers to sticky inflation rates in an economy where prices and wages adjust gradually rather than immediately to changes in economic policy or market conditions. This is driven by adaptive expectations, cost pass-through, and capacity constraints. Once inflation rises, firms and workers adjust their expectations. Those expectations influence today's wage contracts, price strategies, and investment decisions, even if the original price shock fades. In a survey of U.S. businesses conducted after 2022, a majority reported planning annual price increases of 3 to 5%, even as input inflation slowed. Think of inflation as a feedback loop. A shock pushes prices higher, firms expect higher future costs, then prices are raised in advance to protect margins. Next, workers demand higher wages to keep up with prices. Higher wages raise costs, reinforcing the price increases. This loop can continue without new shocks. Average hourly earnings in the US rose by about 4 to 5% year over year through much of 2023. Well above the pre-2019 norm of roughly 3%. Historically, inflation falls slowly. US inflation peaked above 14% in 1980 and did not fall below 4% until 1983. Statistical models show inflation has high persistence. Today's inflation rate will explain a large share of inflation 1 year later. Wage growth follows a similar pattern because wages are typically renegotiated annually. Even after headline US inflation fell in mid-2022 to near 3% in 2023, wage growth remained above 4% for most of that period. Inflation inertia is strongest in sectors with slow adjustment. In housing, rent indexes reflect leases signed 6 to 12 months earlier. In 2022, new tenant rents began slowing, but official rent inflation stayed above 6% well into 2023. In healthcare and education, labor accounts for the majority of costs, so wage increases feed directly into prices. With services, prices rarely fall because cutting wages is difficult. Core services inflation, excluding housing, remained around 4 to 5%, even as goods inflation dropped close to zero. Inflation inertia can be broken, but usually under stress. It weakens when demand contracts sharply, unemployment rises, productivity growth offsets wage gains, and expectations re-anchor at lower inflation. These conditions often come with economic slowdowns. During the early 1980s disinflation, US unemployment exceeded 10% before inflation fell decisively. Persistent inflation shapes economic outcomes. It keeps interest rates higher for longer, increases uncertainty around long-term investment, compresses margins unevenly across sectors, and raises recession risk if policy tightens too much. During high inflation periods, business investment growth has historically slowed by 1 to 2 percentage points compared to low inflation environments. So the takeaway is that inflation is hard to bring down because once higher prices reshape wage setting and expectations, inflation becomes self-reinforcing even after the original shock fades. Like and subscribe to Econopoly for clear, data-driven explanations of economics and markets.